is one of the most misunderstood forms of comfort in business. When a founder sees that the company is generating profit, the natural conclusion is that the business must be financially healthy. If sales are strong, margins appear acceptable, and the accounting reports show that income exceeds expenses, it is very easy to believe that the company is safe. In many cases, that belief becomes the basis for decision-making. Hiring expands, spending increases, new commitments are made. Owners assume the business has enough financial strength to absorb pressure because, on paper, it is profitable. But profitability and financial safety are not the same thing. That distinction is where many businesses get into trouble. A company can be profitable in theory, profitable on its income statement, and still face severe financial stress in real life. It can appear to be succeeding while quietly becoming fragile. It can grow in revenue, report positive margins, and still struggle to make payroll, pay suppliers, cover debt, or meet tax obligations. That is why many businesses do not fail because demand disappears. They fail because cash disappears first. To understand why, we need to separate two ideas that are often treated as if they are interchangeable. The first idea is economic performance. That is what profitability measures. It tells us whether the business is producing value above its cost base over a period of time. The second idea is liquidity. Liquidity tells us whether the business has actual cash available when obligations come due. Those are not identical conditions. A business may be economically profitable and operationally illiquid at the same time. This is one of the most important financial realities a founder, CEO, or operator can understand. Because once a business loses liquidity, the discussion changes very quickly. At that point, strategy becomes secondary. Growth plans become secondary. Even profitability becomes secondary. The immediate question becomes much simpler and much more urgent. Do we have the cash to continue operating? That is why misunderstanding cash flow timing is so dangerous. Most founders are trained by visibility. Revenue is visible. Signed deals are visible. Booked work is visible. Profit on a report looks visible. But timing is less visible. The delay between when revenue is recorded and when cash is actually collected is less visible. The delay between making a sale and funding the work required to deliver that sale is less visible. The difference between earning profit and holding cash is less visible. And because it is less visible, it is often underestimated. This is the central misconception we need to correct. Profit does not mean the cash is already in the bank. Profit does not mean obligations can be met on time. Profit does not mean the business has enough liquidity to survive timing pressure. Profit simply means that according to the accounting structure of the business, value created exceeded cost incurred during a period. That matters. It is important, but it does not answer the operational question that keeps a business alive day to day, week to week, and month to month. The operational question is this: when the business needs cash, will the cash be there? That question sits at the center of business stability. Consider what a founder often sees during a period of growth. Sales increase. Invoices go out. The company appears busier. The pipeline looks strong. Gross profit may even improve. From a distance, this looks like strength, but inside the operating system of the business, something else may be happening. Payroll may rise before customer payments arrive. Vendors may need to be paid before projects are completed. Taxes may accumulate faster than expected. Software, contractors, inventory, fulfillment costs, ad spend, and debt servicing may all require cash now. while the revenue associated with those costs may not convert into cash until much later. That gap is where profitable businesses begin to feel pressure. Not because they are unprofitable, because time is financially expensive. A business does not merely need to earn money. It needs to survive the sequence through which money moves. And sequence matters more than many operators realize. If cash leaves the business in March, but the related customer payment does not arrive until May, the company must finance that gap somehow. It may finance it with retained cash. It may finance it with a line of credit. It may finance it by delaying payments elsewhere. It may finance it by owner injection. But one way or another, that gap must be funded. If too many of those gaps stack at the same time, the business begins to strain. Not because the model is necessarily broken, but because the timing is. This is why financial stress often surprises founders. The business may look good from an income statement perspective. The owner may say, "We are profitable, so why does cash feel tight?" That question reveals the misunderstanding. Profit answers one question. Cash flow answers another. Profit asks whether the business created surplus value over a period. Cash flow asks whether money arrived in the right amounts at the right times to keep the operations stable. Those are different questions, and they create different management responsibilities. If leaders confuse those responsibilities, they tend to overestimate safety. They treat reported profit as if it was spendable cash. They make commitments based on expected collections rather than actual liquidity. They assume growth will solve pressure when growth may actually increase pressure. And because the misunderstanding is conceptual, the problem is often not visible until it becomes acute. By the time liquidity problems become obvious, choices are already narrowing. At that point, management becomes reactive. Payments are delayed. Hiring pauses. Founders become cautious or distracted. Attention shifts away from building the business and toward managing immediate financial tension. That is one reason cash flow is not just an accounting topic. It is a leadership topic. It determines whether management operates from clarity or from constraint. A business with healthy cash flow has room to think. It has room to sequence decisions properly. It can absorb delay, variation, and normal friction without entering instability. A business with weak cash flow may still have demand. It may still have customers. It may still show profit. But it has less room. Less room means less strategic freedom. Less strategic freedom means more reactive decisions. And reactive decisions usually weaken the business further. That is why this topic is foundational. If you understand cash flow correctly, you begin to see business performance more realistically. You stop assuming that sales alone creates safety. You stop treating profit as if it automatically solves liquidity. You begin to study not just how much value the business creates, but when cash enters, when cash exits, how long it takes to convert activity into money, and how much financial tension the business can absorb without destabilizing. That shift in thinking is critical for founders and CEOs because businesses rarely fail in a single dramatic moment. More often, they weaken through sequence errors. They scale before liquidity is ready. They add cost before collections are reliable. They expand commitments before understanding working capital pressure. They interpret profitability as proof of safety and only later discover that the timing structure of the business was never strong enough to support the obligations being created. So this discussion is not about technical finance for its own sake. It is about business survival. It is about learning to distinguish performance from liquidity. It is about understanding why a profitable company can still become financially vulnerable. And it is about seeing that if you do not understand the timing of cash, you do not fully understand the financial condition of your business. That is the starting point. Before we talk about forecasting, working capital, receivables, payment cycles, or cash discipline, we first need to correct the mental model. Profitability is important, but profitability is not protection. Revenue is important, but revenue is not liquidity. And growth is important, but growth does not remove cash pressure by default. In many cases, it intensifies it. Once that is understood, we can move to the next step, which is defining the actual difference between revenue, profit, cash, and liquidity. Because until those terms are clearly separated, founders will continue making financial decisions with the wrong map in mind. In order to understand why profitable businesses can still experience financial stress, we need to clarify three terms that are frequently used as if they mean the same thing. In practice, they describe very different financial realities. Those three terms are revenue, profit, and cash flow. Many founders encounter these concepts through accounting reports, financial dashboards, or summaries prepared by bookkeepers or accountants. The difficulty is that the reports often present the numbers without fully explaining how they relate to the day-to-day financial condition of the business. As a result, it is easy to assume that if the numbers look positive, the business must also be financially comfortable. But each of these terms measures something different. Understanding the distinction between them is the foundation of cash flow literacy. Let us begin with revenue. Revenue represents the total value of sales generated by the business during a given period. If a company sells consulting services, subscription software, agency retainers, or physical products, the revenue figure represents the amount that customers have agreed to pay for those services or products. Revenue is a measure of demand. It tells us whether the market is buying what the company offers. If a business invoices a client for $50,000, accounting systems typically record that invoice as revenue when the sale is recognized. The company has performed the service or delivered the product, and the accounting structure acknowledges that value has been created. However, at this point, something important may still be missing. The customer may not have paid yet. In many industries, payment terms range from 15 days to 30 days, 60 days, or even longer. The revenue is recognized today, but the cash may not arrive for weeks or months. During that time, the business may already be responsible for the costs required to deliver the work. That leads us to the second concept, which is profit. Profit measures the financial surplus generated after expenses are deducted from revenue. It represents the difference between the value created by the business and the cost required to produce that value. If a company produces $100,000 in revenue and its operating costs for that period total $80,000, the accounting result is a profit of $20,000. This number is extremely important because it tells us whether the business model is economically viable. If a company consistently spends more than it earns, it cannot survive long-term without outside funding. But profit is still an accounting measurement. It describes performance over a defined period, based on the rules of financial reporting. Those rules allow revenue and expenses to be recognized according to when economic activity occurs, rather than when money physically changes hands. This system is called accrual accounting. Accrual accounting is valuable because it allows leaders to understand whether their business model works. It connects revenue with the costs required to generate that revenue. But it also means that the income statement can show profit even when the associated cash has not yet arrived. That is where the third concept becomes essential. Cash flow describes the actual movement of money into and out of the business. Unlike revenue and profit, which rely on accounting recognition, cash flow tracks real financial movement. When a customer payment arrives in the company's bank account, that is cash inflow. When the business pays salaries, vendors, rent, taxes, advertising costs, or software subscriptions, that is cash outflow. Cash flow answers a practical operational question: how much money is entering the business and how much money is leaving it. This distinction becomes easier to see when we look at a simple operating sequence. Imagine a small agency that signs a new client project worth $60,000. The agreement is signed in January, and the agency immediately begins work. According to accounting principles, that contract may be recognized as revenue during the period when the work is performed. However, the client may have payment terms that require 30 or 45 days before payment is due. Meanwhile, the agency must pay employees, contractors, project managers, software tools, and administrative overhead during the time the work is being delivered. In the accounting system, revenue may already appear on the books. Profit may even appear if the project margin is healthy. But the cash associated with that project has not yet arrived. If several projects follow the same pattern, at the same time, the agency may appear financially successful in its reports while still experiencing pressure in its bank account. This is the core difference between accounting performance and liquidity. Accounting performance evaluates whether the business generates value relative to cost. Liquidity evaluates whether the company has enough cash available to meet its obligations when those obligations occur. A business may show excellent accounting performance and still experience liquidity strain if the timing between revenue recognition and cash collection becomes too wide. Another example often appears in companies that are growing quickly. As sales increase, the business may hire additional staff, purchase equipment, invest in marketing, or expand infrastructure to support the higher demand. These costs often require immediate payment. Payroll occurs every 2 weeks. Vendors expect payment on schedule. Advertising platforms charge monthly or immediately. But customer payments may still arrive slowly. The result is that the business is profitable on paper, yet cash leaves the company faster than it arrives. The accounting reports remain positive, but the operating bank balance begins to tighten. From the perspective of a founder without a financial background, this situation can feel confusing. The income statement shows that the company is profitable. Revenue is increasing. Clients are active. Yet the bank balance feels uncomfortable. The reason is that revenue, profit, and cash are measuring different aspects of financial activity. Revenue measures sales activity. Profit measures economic efficiency. Cash flow measures financial timing. When founders understand this separation, they begin to see why financial pressure can appear even in businesses that seem to be performing well. The company is not necessarily failing. Instead, the timing of money moving through the system may be out of alignment with the timing of the company's obligations. That timing gap is the space where cash flow management becomes critical. When leaders understand revenue but not cash flow, they tend to assume growth automatically strengthens financial stability. In reality, growth often increases the amount of cash required to operate the business. More clients mean more work. More work means more payroll. More payroll means more immediate cash requirements. If customer payments arrive slowly, the company must bridge the difference between when expenses occur and when revenue converts into cash. Without a clear understanding of these concepts, it is easy for founders to make decisions based on the wrong signal. They may expand spending because the income statement shows profit, without realizing that the liquidity needed to support those commitments has not yet materialized. Once the difference between revenue, profit, and cash flow becomes clear, the financial picture of a business becomes easier to interpret. Leaders stop assuming that accounting success guarantees operational stability. Instead, they begin monitoring the flow of money through the business as carefully as they monitor the profitability of their work. That shift in perspective sets the stage for the next concept we need to examine. Because once we understand these definitions, the next question becomes much more practical. How exactly does cash move through a business? And why does the timing of that movement create pressure even in companies that are growing and profitable? Now that we have clarified the difference between revenue, profit, and cash flow, the next step is to examine the actual mechanics of how money moves through a business. This is where the subject becomes practical. Financial stability is not determined solely by how much revenue a company produces, but by how money flows through the operating cycle of the organization. Every business operates through a sequence of financial events. Revenue is created, work is delivered, expenses are incurred, invoices are issued, and payments are eventually received. These events do not occur at the same moment. They occur in stages, and the spacing between those stages is what creates either stability or financial tension. To understand this clearly, we can break the financial mechanics of a business into 5 components: revenue recognition, cash inflows, operational expenses, financial timing, and liquidity management. Let us begin with revenue recognition. Revenue recognition refers to the accounting process that records when a company has earned income from delivering its product or service. In most businesses, revenue is recognized when the work has been performed or when the product has been delivered according to the terms of the agreement with the customer. For example, if a consulting firm completes a project for a client, the value of that project may be recognized as revenue once the service has been provided. In the accounting system, that revenue is recorded because the company has fulfilled its obligation. From an accounting standpoint, the business has earned that income. However, recognizing revenue does not necessarily mean that money has entered the company's bank account. This distinction is important because the accounting recognition of revenue is only the first stage in the financial cycle. The next stage involves cash inflows. Cash inflows occur when the customer actually pays the invoice associated with the work that was performed. Depending on the structure of the business, this payment may arrive immediately, or it may arrive weeks later. In many industries, customers operate on payment terms such as 30 days, 45 days, or 60 days after the invoice is issued. During this period, the business has technically earned the revenue, but the cash has not yet arrived. While the company is waiting for that payment, the business continues to operate. Employees must still be paid. Contractors must still receive compensation. Software subscriptions, office costs, marketing expenses, and supplier invoices all continue to occur according to their own schedules. These are operational expenses. Operational expenses represent the costs required to run the business on a day-to-day basis. Payroll is often the largest component, but it is rarely the only one. A typical company must also manage vendor payments, utilities, software platforms, logistics costs, professional services, advertising budgets, insurance, taxes, and various forms of overhead. Unlike customer payments, which may arrive after a delay, Many operational expenses occur on fixed schedules. Payroll may occur every 2 weeks. Vendors may expect payment within 15 days. Advertising platforms may charge monthly or even immediately. These expenses represent cash leaving the business. This is where financial timing becomes critical. If the timing of cash inflows and cash outflows is aligned properly, the business operates smoothly. Customer payments arrive in time to cover payroll, vendors, and other obligations. The company maintains a stable bank balance and retains the flexibility to invest in growth or absorb temporary disruptions. However, if the timing becomes misaligned, financial pressure begins to appear. Consider a situation where a company delivers work in January, recognizes revenue in its accounting system, but does not receive payment from the client until March. During the months of January and February, the company must still fund all of the costs associated with delivering that work. Salaries must be paid. Contractors must be compensated. Operational expenses continue, regardless of whether the client has paid yet. This creates a gap between when revenue is recognized and when cash actually enters the business. If the company has strong liquidity reserves, this gap may not cause any problems. The business simply uses existing cash to fund operations until the payment arrives. But if the company operates with limited reserves, multiple gaps occurring simultaneously can create financial tension. This leads to the concept of liquidity management. Liquidity management refers to the practice of ensuring that the company always has sufficient cash available to meet its obligations as they come due. It involves monitoring the flow of money through the business, forecasting upcoming expenses, and understanding when customer payments are expected to arrive. Effective liquidity management requires leaders to think in terms of timing rather than just totals. A business may generate significant revenue during a quarter, but if most of that revenue converts to cash later in the cycle while expenses occur earlier, the company must be prepared to bridge that difference. Without planning for that gap, the business may find itself in a situation where it is technically profitable but temporarily unable to meet immediate financial obligations. This is why financial stability depends on more than revenue growth. It depends on the relationship between inflows and outflows. When inflows arrive faster than outflows leave, liquidity strengthens. When outflows occur faster than inflows arrive, liquidity weakens. Over time, even a profitable business can experience stress if the sequence of payments consistently places pressure on available cash. Founders who do not study these mechanics often assume that financial success is simply a matter of increasing sales. Sales are important, but sales alone do not determine whether a business can sustain its operations. What matters equally is how efficiently the business converts its activity into cash and how carefully it manages the timing of its expenses. When leaders begin to understand the movement of money through the organization, they start to see patterns that were previously invisible. They recognize where delays occur in customer payments. They see which expenses require immediate cash and which can be scheduled more strategically. They begin to measure how long it takes for a dollar spent on operations to return to the business as a dollar received from customers. This awareness changes how financial decisions are made. Instead of focusing only on revenue growth, management begins to consider the full cycle of financial activity. They examine how work is funded before payment arrives. They monitor receivables more carefully. They establish systems that ensure cash remains available at the moments when it is required. In other words, they shift from thinking about financial performance in static terms to thinking about it as a moving system. A business is not simply a set of numbers on a report. It is a sequence of financial movements that occur continuously. Understanding that sequence is what allows leaders to maintain stability while the company grows. And once that sequence becomes visible, it also reveals something else. Many of the financial pressures experienced by profitable businesses are not caused by weak demand or poor margins. They are caused by the structure of the operating cycle itself. To understand why that structure creates pressure, we need to look more closely at one of the most important concepts in cash flow management: the gap between spending money and receiving it. Once we understand how money moves through a business, the next step is to examine why financial pressure often appears even when the company is performing well from a revenue or profitability standpoint. In most cases, liquidity problems are not caused by a single dramatic event. Instead, they emerge gradually through structural patterns in how the business grows and operates. Several forces tend to create this pressure over time. Among the most common are operational growth, delayed customer payments, expansion of fixed costs, increasing operational complexity, and the absence of disciplined financial forecasting. Each of these factors may appear reasonable in isolation, but together they can quietly reshape the financial structure of the business. Let us begin with operational growth. Growth is typically interpreted as a sign of success. More customers, larger projects, higher sales volumes, and expanding teams all suggest that the company is moving in the right direction. However, growth almost always requires additional resources before the corresponding revenue converts into cash. When a business signs new clients, it must allocate staff, time, and infrastructure to deliver the promised work. Employees may need to be hired, or existing staff may need to work additional hours. Contractors may be engaged. New software systems may be implemented. Marketing efforts may increase to maintain momentum. All of these activities require spending. The important detail is that these costs usually occur before the business receives payment from the customer. The company must fund the work in advance. If the business signs several new projects at the same time, the amount of cash required to support those projects increases immediately, while the associated payments may arrive weeks or months later. This dynamic often surprises founders because it means that growth can temporarily increase financial pressure rather than relieve it. The second structural cause is delayed customer payments. In many industries, payment terms are standard practice. Businesses may invoice clients after work is completed and expect payment within 30 days, 45 days, or even longer. Larger corporate clients may operate on extended payment cycles that significantly delay the arrival of cash. While waiting for these payments, the business continues to operate normally. Salaries must be paid on schedule. Vendors must receive payment according to their terms. Taxes must be filed and paid. Operational costs continue regardless of whether customer payments have been received. If collections slow down, or if customers consistently pay later than expected, the gap between revenue recognition and cash collection widens. Over time, this gap accumulates into meaningful financial pressure. The third factor involves the expansion of fixed costs. As businesses grow, they often convert variable costs into fixed commitments. New employees may be hired on salary. Office space may be expanded. Software subscriptions may increase. Equipment leases may be signed. Management layers may be added to coordinate larger teams. Fixed costs create stability in operations, but they also increase the baseline amount of cash required each month to keep the organization running. Once these commitments are in place, they must be paid regardless of fluctuations in customer payments. When revenue grows steadily, these costs appear manageable. But if collections slow, or if several payments are delayed simultaneously, the fixed nature of these expenses means that the business must still meet them on time. This can quickly reduce available liquidity. A fourth cause is operational complexity. As organizations expand, their financial systems become more complicated. There are more clients, more projects, more vendors, more employees, and more financial transactions moving through the system. Each of these elements introduces additional timing differences between when work is performed, when invoices are issued, when expenses occur, and when payments are collected. In smaller businesses, founders may be able to track these movements intuitively. They know which clients pay quickly, which projects require upfront spending, and when major expenses are scheduled. But as the organization grows, intuition becomes less reliable. The financial system becomes too complex to manage without structured visibility, without clear processes for tracking receivables, monitoring obligations, and sequencing payments. The flow of money becomes harder to predict. Financial pressure may develop quietly because the business no longer has a clear view of when cash will arrive relative to when it must leave. The final structural factor is the lack of financial forecasting. Many founders focus primarily on revenue targets and sales performance. While these metrics are important, they do not provide a complete picture of the company's financial trajectory. Forecasting involves projecting not only future revenue, but also the timing of cash inflows and the schedule of upcoming expenses. Without this forward-looking view, leaders may make commitments based on expected revenue without fully understanding when that revenue will convert into cash. Hiring decisions, marketing investments, and operational expansions may be approved under the assumption that future income will cover those costs. However, if the timing of collections does not align with the timing of those commitments, the company may find itself in a situation where the income statement looks strong, but the bank balance becomes constrained. What makes these structural causes particularly challenging is that they rarely appear as immediate crises. Instead, they develop slowly. A business signs a few additional clients and increases payroll to support them. Customer payments begin arriving slightly later than expected. A few new software platforms are added. Marketing spending increases to sustain growth. Each decision appears reasonable at the time, and the overall revenue trajectory may still look positive. But beneath the surface, the sequence of cash movement is changing. Expenses begin occurring earlier in the operating cycle. Payments from customers begin arriving later in the cycle. Fixed costs gradually increase the minimum cash required each month. Forecasting remains focused on revenue rather than liquidity. Over time, these patterns accumulate. The company may still report healthy profits, yet management begins to notice that cash reserves are thinner than expected. Bank balances fluctuate more dramatically. Financial decisions require closer monitoring. The business may still be performing well commercially, but the margin for financial error becomes smaller. This is how liquidity problems often develop. They do not necessarily indicate that the business model is flawed. Instead, they indicate that the financial structure of the operating cycle has become misaligned with the timing of the company's obligations. Understanding these structural causes allows leaders to recognize that cash pressure is often a predictable consequence of growth and complexity rather than a sign of failure. When founders become aware of these dynamics, they can begin implementing systems that bring visibility and discipline to how money moves through the business. That discipline is what transforms cash flow management from a reactive process into a strategic capability. To make this concept fully practical, let us walk through a realistic example of how a company can be profitable and still experience cash pressure. The purpose of this example is not to create an extreme situation. It is to show how normal operating conditions can gradually create liquidity strain when the timing of inflows and outflows is misunderstood. Assume we are looking at a service business. It could be an agency, consultancy, implementation firm, or specialized B2B service provider. The business is growing, demand is healthy, and management believes the company is performing well. The company signs 3 new client contracts in January. Client A is worth $40,000. Client B is worth $35,000. Client C is worth $25,000. That means total new revenue for the month is $100,000. On paper, this looks strong. The founder sees 6 figures of work sold in a single month. If the direct cost of delivering that work is manageable, the business may appear highly profitable. Now let us add some realistic delivery economics. To deliver these projects, the company incurs the following January costs: payroll for staff, $32,000, contractors and freelancers, $12,000, software and tools, $3,000, rent, admin, and operating overhead, $8,000, marketing and sales costs, $7,000. That brings total January operating expenses to $62,000. If we stop here and look only at revenue and expenses, the numbers seem healthy. Revenue, $100,000, expenses, $62,000, accounting profit, $38,000. From an income statement perspective, this appears to be a strong month. The founder may reasonably conclude that the company is doing well. A $38,000 profit suggests financial strength. But we are not finished. We have only looked at economic performance. We have not yet looked at cash timing. Now let us define the payment terms. Client A pays on 30-day terms, Client B pays on 45-day terms, Client C pays 50% upfront and 50% in 30 days. This changes the actual cash picture significantly. In January, the company does not collect the full $100,000. Instead, here is what happens. Client A pays nothing in January. Client B pays nothing in January. Client C pays $12,500 upfront in January. So even though the company recognized $100,000 in revenue, actual cash collected in January is only $12,500. Now compare that with cash leaving the business in January. Payroll still has to be paid. Contractors still need payment. Software, rent, overhead, and marketing all still require cash. Total January cash outflows remain approximately $62,000. So the January liquidity position looks like this. Cash in, $12,500. Cash out, $62,000. Net cash movement, negative $49,500. At this point, the business has a profitable month on paper, but a severe cash deficit in reality. How does the business survive that gap? It can survive only if one of the following is true. It had enough cash reserves at the start of the month. It uses a line of credit. The owner injects capital. It delays some payments. This is the first key lesson. Profitability did not prevent cash pressure. The reason is simple. Revenue was recognized before the majority of cash was received, while expenses had to be funded immediately. Now let us continue into February, because this is where founders often become more confused. The company continues growing. Encouraged by January sales, the founder signs additional work in February. New February contracts total $90,000. That seems positive. The company is still growing. Demand still looks strong. To support this workload, the founder adds more contractor support and slightly increases payroll hours. February expenses now look like this. Payroll, $34,000. Contractors, $15,000. Software and tools, $3,200. Rent, admin, and overhead, $8,000. Marketing and sales, $7,800. Total February expenses, $68,000. Again, the income statement may still look healthy. If revenue recognized in February is $90,000 and expenses are $68,000, the company shows a profit of $22,000 for February. So after 2 months, accounting suggests the business is working. January profit, $38,000. February profit, $22,000. Total accounting profit over 2 months, $60,000. A founder who looks only at profitability may think the business is becoming stronger. But now, let us follow the cash. In February, the company receives Client A from January, $40,000. The second half of Client C from January, $12,500. Client B from January still has not paid because it is on 45-day terms. From the new February contracts, assume one client prepays $10,000. That means February cash inflows total $62,500. February cash outflows are $68,000. So February net cash movement is negative $5,500. Now combine that with January. January net cash movement, negative $49,500. February net cash movement, negative $5,500. Total cash movement over 2 months, negative $55,000. This means that even though the business has reported $60,000 in accounting profit over January and February, it has consumed $55,000 of cash over the same period. This is not a contradiction. It is a timing issue. The company is making money economically, but it is using cash faster than it is collecting it. Now, let us make the situation even more realistic. Suppose in late February, Client B delays payment by another 2 weeks because their accounts payable department is slow. That $35,000 expected collection does not arrive when planned. At the same time, payroll is due, contractor invoices arrive, and quarterly tax obligations begin to appear. The founder now experiences what many business owners describe as a confusing form of financial stress. The business is busy, clients are active, revenue is strong, profit exists on the books, yet cash feels tight. This is where liquidity pressure becomes operationally dangerous. The founder may start making short-term decisions, delay paying a vendor, reduce marketing unexpectedly, pause a hire, use personal funds, temporarily rely on credit cards or short-term borrowing. None of these actions happen because the business is unprofitable. They happen because the business is underfinanced relative to the timing of its obligations. Now let us summarize the mechanics step by step. Step 1. The business sells profitable work. This creates revenue and, after expenses, accounting profit. Step 2. The business begins delivery immediately. To deliver the work, it must fund payroll, contractors, tools, and overhead. Step 3. Customers pay later than the expenses occur. Revenue is recognized now, but cash arrives in stages. Step 4. Growth increases the amount of work being funded in advance. Each new client adds more near-term cost before full collection occurs. Step 5. The business uses its own cash to bridge the timing gap. If reserves are insufficient, pressure builds. Step 6. Any collection delay makes the system tighter. One late payment can create a chain reaction because fixed obligations do not wait. This is the core point founders need to understand. A profitable company can still run out of cash because profit measures surplus over time, while liquidity depends on when money actually moves. If inflows arrive after expenses are due, the business must carry that timing burden. And if the burden grows faster than available cash, the company becomes financially vulnerable even while remaining profitable on paper. This is why operators must monitor timing, not just totals. It is not enough to ask, "Are we profitable?" The more operationally intelligent question is, when does the cash arrive relative to when the cash leaves? That question determines stability. Once a leader starts asking that question consistently, cash flow stops feeling mysterious. The pressure becomes explainable. More importantly, it becomes manageable. And that is what leads us into the final step of this discussion, which is how experienced leaders reduce this kind of pressure through visibility, forecasting, and disciplined cash management. At this point, we have established an important principle. Profitability does not automatically create financial stability. A company can generate revenue, report profit, and still experience operational pressure if the movement of cash through the business is not understood or controlled. The final step in this discussion is to examine where the system usually breaks down and what leaders should monitor in order to maintain control of liquidity. Cash flow problems rarely appear suddenly. They develop gradually when visibility and discipline are missing from the financial system. Most organizations do not lose control because they lack revenue. They lose control because they do not track the financial signals that reveal how money is moving through the business. Several key metrics provide that visibility. The first is liquidity. Liquidity refers to the amount of cash that is immediately available to meet short-term obligations. It answers a practical question. If payroll, vendor payments, taxes, and operating costs were due this week, could the company pay them without stress? A business may have strong revenue, but weak liquidity if customer payments arrive slowly or if operating costs have expanded too quickly. Leaders should always understand how much accessible cash the business holds and how that amount compares to the obligations scheduled over the coming weeks. The second metric is receivables. Receivables represent money that customers owe to the business for work that has already been delivered. In many organizations, receivables become one of the largest hidden drivers of liquidity pressure. When clients delay payment, the company effectively finances their operations. The business continues paying salaries and expenses while waiting for money that has already been earned. If receivables begin stretching beyond their expected collection time, the company's cash cycle becomes longer and more expensive to sustain. This is why disciplined organizations track not only the total value of receivables, but also their aging. Management needs to know how much revenue is waiting to be collected and how long those payments have been outstanding. The third metric is fixed cost exposure. As businesses grow, they often accumulate fixed commitments such as salaries, leases, software platforms, and recurring vendor contracts. These obligations must be paid regardless of whether customers have paid their invoices. The higher the fixed cost base becomes, the more predictable cash must be entering the business each month. If fixed costs grow faster than reliable collections, the company becomes structurally fragile. Monitoring the relationship between fixed costs and dependable revenue helps leaders understand how much financial pressure the business can absorb. Another important indicator is cash runway. Cash runway measures how long the business can continue operating if current inflows slow or stop temporarily. It is calculated by comparing available cash to the average monthly expenses required to run the company. A healthy runway gives leadership time to respond to unexpected events such as delayed payments, economic slowdowns, or operational disruptions. A very short runway means the business has little margin for error. Even a minor delay in collections can create serious financial tension. The final metric that brings these ideas together is the cash conversion cycle. The cash conversion cycle measures the time required for a dollar spent by the company to return as a dollar received from customers. In other words, it tracks how long money remains tied up inside operations before it returns as usable cash. A shorter cycle strengthens liquidity because money moves through the system quickly. A longer cycle increases pressure because the business must finance operations for a longer period before it is paid. Understanding this cycle allows leaders to see where financial friction exists. Delayed invoicing, slow collections, and early expenses all lengthen the cycle. Improving these areas reduces the amount of cash required to sustain the same level of activity. When these metrics are ignored, the system gradually loses control. Receivables accumulate without active follow-up. Fixed costs expand faster than dependable income. Liquidity shrinks because management assumes future revenue will solve the problem. The company continues operating successfully on the surface while its financial flexibility slowly declines. The solution is not complicated, but it requires discipline. First, leaders must maintain continuous visibility into their cash position. Financial reports should not only describe past performance, they should show the current liquidity situation and the obligations approaching in the near future. Second, businesses should monitor receivables closely and establish consistent collection practices. Revenue that remains uncollected for long periods weakens the entire financial structure of the organization. Third, companies should be cautious when expanding fixed commitments. Growth should be supported by predictable cash inflows rather than optimistic projections. Fourth, financial forecasting should extend beyond sales expectations. Leaders should regularly project when cash will enter the business and when expenses will occur. This forward view allows management to anticipate pressure before it becomes urgent. Finally, organizations should maintain reasonable cash reserves. A liquidity buffer allows the business to absorb timing differences between inflows and outflows without destabilizing operations. When these principles are applied consistently, something important happens. Cash flow stops being unpredictable. Leaders can see where pressure may develop weeks or months in advance. Instead of reacting to financial stress, the company begins managing liquidity proactively. This is what creates financial stability. Stable companies are not defined only by their revenue or their margins. They are defined by their ability to convert activity into cash efficiently and predictably. When the timing of inflows and outflows is understood, management decisions become clearer. Hiring, investment, and growth can occur without threatening the operational health of the business. The lesson behind this entire discussion is straightforward. Revenue indicates that customers want what the business offers. Profit indicates that the business model can generate surplus value. But cash flow determines whether the company can continue operating without interruption. If leaders focus only on revenue and profit, they may miss the financial mechanics that keep the organization alive. When they understand cash flow, they gain control over the timing, stability, and resilience of the entire enterprise. That is why profitable businesses sometimes run out of cash. And that is also why disciplined cash flow management is one of the most important capabilities a business leader can develop. A company that understands how money moves through its system can grow with confidence. A company that ignores those movements may discover, often unexpectedly, that profitability alone does not guarantee survival.